Welcome back to What's Hot, What's Not, C.R.E. It's Friday, March 6th, 2026, and today we're tracking where institutional capital is actually flowing right now. Let's get into it. What's hot? Data centers are the clear winner. Hyperscaler spending is projected to hit $527 billion in 2026, up from $465 billion last year. Some estimates have the big five cloud providers collectively spending up to $690 billion this year, nearly doubling 2025 levels. Power availability, not location or cost, has become the primary site selection criterion. Industrial logistics remains a favorite. Core capital is returning with a focus on institutional quality facilities, strong tenant credit, and markets aligned with reshoring and manufacturing investment. Vacancy is expected to stabilize in the mid-6% range with moderate rent growth. Grocery-anchored retail is surging. Transaction volume jumped in 2025, and institutional investors are increasing their share of acquisitions. Necessity-based demand, stable cash flow, limited new construction, and improving leasing activity are the draw. Capital is also expanding into power centers and strip centers. Multifamily Class B workforce housing continues to attract capital. Occupancy around 95.8%. Rent growth projected at 2.3%. And an affordability gap that's insulating demand. And finally, private credit is filling the gap left by traditional lenders. With over $620 billion in high-yield bonds and leveraged loans maturing in 2026 and 2027, private debt's speed and flexibility are winning deals, especially for bridge and value-add strategies. Now for what's not. Office is still the sector smart money avoids. CMBS office delinquency hit a record 12.34% in January 2026, surpassing the 2008 financial crisis peak. Distress is concentrated in older, functionally obsolete buildings. Capital is only flowing to Class A, amenity-rich properties in select gateway cities. Suburban Class B and C office is effectively dead money unless repositioned to residential, flex, or mixed use. Over-leveraged deals facing 2021-era maturities are being avoided. With rates elevated and over $1.5 trillion in CRE debt maturing by year-end, deals that don't pencil at current rates aren't getting refinanced. And Sunbelt Class A multifamily with high vacancy and concessions above 30% is on the avoid list. So, why it matters? Capital allocation in 2026 is selective, not risk-on. The LightBox CRE Activity Index jumped 28% in January to 110.7, signaling renewed transaction momentum. Colliers forecasts 15 to 20% sales volume growth, but investors are targeting durable income through core plus and value-add strategies, not speculative plays. Your investor takeaway. Smart money is flowing to data centers, industrial logistics, grocery-anchored retail, and Class B workforce housing. Avoid suburban office, over-leveraged maturities, and Sunbelt Class A. Focus on assets that work at current rates with stable occupancy. That wraps up the week. Have a great weekend. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.